kicking off the afternoon, which will look at issues of anti-money laundering, identification, crypto assets, smart contracts, are Sean and André looking at the importance of digital documentation in the use of financial services and financial transactions. We come to that in a moment, but I would like to first introduce both of them. Sean Edwards is the head of legal and special advisor to the Global Trade Finance Department of SMBC, but importantly, he's also here today in his role as the chairman of ITFA, the International Trade and Forfaiting Association. He is joined by André Casterman, who is a board member of ITFA, but, and I'm very delighted for the purpose of this conference, also chairs the Fintech committee of ITFA. Maybe I start with you, Sean, this afternoon. Maybe you can say a few words on ITFA, because I'm not sure everybody will know the organization, and also the interest around fintech and digital documentation.
Of course, yes. This is a role in which my two jobs actually coincide quite well. So ITFA has been around for just over 20 years. We were originally the IFA, International Forfaiting Association, and the reason we changed our name actually is we broadened very much the scope of what we do and our membership. We've got currently just over 300 members in over 40 countries around the world. We're organized through regional committees or chapters from north, south, west, and east. We have a Chinese group. We have a group in Australia, New Zealand. We have a very active group in the US, and of course we have a lot of different committees in Europe. I say we started in the forfaiting markets. Originally, forfaiting was about the origination and distribution, the selling of negotiable instruments like bills of exchange and promissory notes, which seem very quaint today. But actually, they were fantastic instruments to open up the emerging markets because they are known and recognized globally. They are the remnants of colonization, of British and French colonization. And so when in the 1980s and 90s, a lot of the merchant banks in London were looking as to how they could safely invest in markets, say in South America and Asia, they found those instruments to be the best point of entry into those markets. They, as I say, they have centuries sometimes of legal pedigree, and they're essentially the same the world over. They're simple. They're promises to pay, unconditional promises to pay, and they can be traded. They're negotiable instruments. So not only could you originate effectively an unconditional debt obligation, you could be pretty sure about what legally that was worth, but also very importantly, you could trade it, and therefore that created a very big secondary market. Now, the big problem, though, is that these instruments used what was the best available technology at the time, which was paper, and that is no longer the best available technology. And of course, whilst it has some advantages, it's cheap and it's relatively interoperable. It's slow. It can be forged very easily. It requires these documents, which are valuable documents in their own right. So if you lose a promissory note or a bill of exchange, you've actually lost, almost like losing a dollar bill or a euro note. It's actually valuable paper. And operational inefficiencies and costs meant that they went out of favor, but they are great instruments. So with the advent of digitization, which André will talk about a lot more, we now have the ability to have effectively the best of both worlds. We can have these wonderful instruments that are recognized around the world, that are very simple debt obligations that are tradable, and we hope therefore will be attractive to non-bank investors, something we've been looking at and spending a lot of time on in it. We just think that they are a great tool for the trade finance market. Remember, the trade finance gap is 1.7 trillion. It's grown, but we think we have a chance to make a dent in that with these.
And maybe before coming to André on some of the practicalities, I'd just like to drill down into this kind of suggestion you made that introducing digital documentation could be quite transformative. Maybe explore a little bit more where this trade gap is coming from, the 1.7 trillion you mentioned, and the type of savings and efficiencies that we might want to see if we were to move to digital documentation.
Yeah. Okay. So yeah, the 1.7 trillion is the Asian Development Bank, and that is that's their study that's been going on for a number of years. And for a while, it was sort of hovering at around the 1 to 1.5 billion mark. Post-pandemic, it's gone up to 1.7 trillion, and unfortunately, a lot of that is composed of a lack of financing for SMEs. So the big oil traders, they need and have managed to find a lot of liquidity to buy to buy commodities at their new inflated prices. So that's not where the problem is in trade finance. The problem really is in the small, especially the small, but also the medium companies that are finding it increasingly hard to get finance. I mean, for example, Bangladesh, it was announced a couple of weeks ago, has run out of letter of credit capacity. So these are really quite serious issues. So that's where the need is now. What's the transformative effect? Well, Coriolis with the ICC did a study in the UK, and they looked at what the efficiency savings and the extra amount of trade finance that could be freed up if we move to digital documentation. And I should just say here, we're talking about the three main types. So the bills of exchange, the promissory notes, and the bills of lading, which are transport documents. But are also used effectively to secure finance, because the other important thing, especially with transport documents, is that they act as documents of title. So if you have a bill of lading, you actually own the underlying cargo, whatever that is. It could be $100 million worth of oil. You own that through the bill of lading. So obviously banks use that as collateral. Now, and this is just the UK. They identified £25 billion in potential new growth if we digitize trade documents. The number of days for processing these documents would reduce by 75%. That would free up a massive £224 billion in efficiency savings, and just directly £1 billion extra for trade finance. If you multiply that across the G7 or indeed globally, you'll see all of those. There'll be orders of magnitude of that saving, but that's one relatively small but still important trading country. So when you extrapolate that to what the savings will be globally, they are absolutely massive. Maybe we'll come on to it later, but currently the big blocker is the law. As I say, these documents have to be paper, therefore the law has to be changed to use the technology that is there. So that's the blocker at the moment, and we'll talk about that later probably, because there's been a lot of progress there. What are the new markets that we think will come into being? Well, we've been talking with one of the big US exchanges to see whether they would be interested in actually creating an exchange for debt, which effectively takes the form of a digital promissory note. There have been discussions with local authorities, municipalities here in the UK to see whether they could do something similar to modernize and make the current system they have for allocating debt across local authorities more efficient. So but we're really at very early days on this, and I think it's important. Some of this is corporate finance. So very much on the bill of lading side, on the transport document side, it's very much about greater efficiency. But on the financial document side, bills of exchange, promissory notes, it's really about creating new financial markets. These were the markets that existed in the 80s, 90s, the 2010s in the forfaiting market. That liquidity now, and one of the reasons, part of the reason that market declined was paper. Another reason, though, was that a lot of this financing was held on balance sheet. We're essentially talking about short-term trade, 3 to 6 months. That was held on balance sheets. Now, balance sheets, bank balance sheets, even the big ones, are not what they were in the 2010s, all right, whether that's pre or post GFC. So There's an increasing focus on optimizing balance sheets, on distributing risk, on managing bank capital, especially through the new Basel rules. Basel 3.1 is going to make it less advantageous to do trade finance. There are lots of reasons why we need this, lots of potential to create the market. But unlike bills of lading, which currently exist, every shipment has a bill of lading. Currently, 99% of those are paper. We do need to create or recreate that financial market. But the signs are very good, and there's a lot of interest in it.
Thank you very much indeed, Sean, for laying that out. So if I were to summarize two main efficiency gains, one just operationally moving from paper to digital and legal costs and administrative costs, and the other one just the potential of creating a whole new market with its efficiencies around liquidity and capital management.
Yeah, just one thing to add on the new market. Of course, what a digital promissory note looks very much like is a sort of bond, right? It's something that can be listed once it's digitized. That's why we've been talking to exchange. So it starts to look like Euro bonds or even equities. It starts to look a lot more like the capital market instruments that a lot of the non-bank investors have traditionally invested in, but which don't exist for trade. So now we have, again, this opportunity, the need, but also the opportunity.
Thank you. And in a period where we've got reduced international trade for all kinds of reasons, not least COVID and global conflict, creating more legal certainty in this space would certainly help to facilitate trade flows. With that, maybe André, over to you. We've talked a bit about the potential of digital documentation, but in your role as chair of the Fintech committee, what would it look like practically? What is needed and what type of documentation would need to be digitalized to achieve the gains that Sean has just laid out?
Yes, indeed, Nick. We have on the Fintech committee side that we set up within ITFA in 2017. We have created an initiative, the Digital Negotiable Instrument Initiative, because we have identified that digitizing trade documents can be done actually quite easily from a pure technology perspective. And why do I dare saying that can be done quite easily is that because we don't need to change most of the systems that the banks use today. A bit like the analogy I'd like to suggest is the one with the electronic signature. When the industry across multiple segments introduced electronic signature, we didn't change the content of contracts. We just added a piece of technology to enable contracts or payment flows to be signed digitally instead of on paper, offline. So, and we know the names of the major electronic signature technology providers. And on the digitization of negotiable instruments, the ones that Sean just mentioned, which are part of this model law for electronic transferable records, is the same logic. We don't need to change what is working, the major trade applications, the major channels, portals that banks and corporates use, including SMEs, but we need to add a piece of technology that will actually transform a document into an MLETR compatible document. That means a document that is considered as sufficiently secure to be the single original document, and that is possessed by someone in an exclusive way, so that the ownership of the promissory note or the bill of exchange or the bill of lading or the warehouse receipt can be proven electronically, and that possession can be transferred also digitally to the next counterparty. And we have proven this approach over the last 3-4 years because we have found, as part of our membership, we have 60 plus fintech members within ITFA. We have found one company that has been focusing on this value proposition, and we have worked to integrate them into the major trade application vendors. The big names supporting the back office and the front office systems of large and smaller banks are enabled on this technology, and this is why we have been able already to organize pilot phases and get some of those banks to bring this to life in particular jurisdictions. So it's not a huge technology impact. It's all about finding the right technology mix. And I think the major transformation we have seen over the last decade on the technology front is the development from the cryptographic world, I should say. From that space, we have seen the digital asset technologies being developed, which aim at basically providing more value on an electronic record. And value comes from ownership, from indeed being able to consider that as an asset that can be owned, transferred, sold, and that is creating a market. And basically, we are bringing trade finance with this whole industry transformation into the digital asset world. The same technologies that are being used today for CBDCs, stable coins, and NFTs. So it's very much leapfrogging a lot of technology developments for trade finance to basically take advantage of those technologies.
I think, André, you've already anticipated my next question, which is, why hasn't this happened before? Because I remember working in the early 2000s on the original e-signature directive, for example, which was to lead the way within the single market for the recognition of electronic communications, but not necessarily electronic documents. So why is it taking us another 20 years to come to this point? Is this because the technology has evolved, or because the regulatory framework has caught up with developments? Why now?
I think the most important happening now is the alignment of policy developments with technology developments. Both are very much aligned. The technology has not been able to have a sufficient impact over the last 20 years. There were different types of technology options available to digitize bills of lading, for instance, but the way they were commercialized was too much of a club structure and proprietary solutions. Now what the market wants are open solutions that do not require basically banks to force all of their clients, including SMEs, into a third-party platform. So we have seen bills of lading platforms and club structures over the last 25 years. However, those were not supported by the appropriate regulatory and legal frameworks in order to basically have mainstream adoption. And those regulatory developments, thanks to UN having developed the MLETR and published it in 2017, those regulatory developments are now supported by the G7 and by major stakeholders like WTO, ICC. And on the ITFA side, we are also a party promoting those regulatory developments and supporting the banks in different countries around the world to make it happen. So we are really focusing on alignment of those country-specific policy developments with the uptake of new technologies.
If we apply this now to the European context, because in our conference we look at global developments, but also predominantly at European developments, what do you think would be needed from the EU institutions, from the European Commission, to facilitate this process and to contribute to legal certainty? I know Sean was already alluding that there's an issue here. What would you like to see?
Well, I think people say a lot about the pros and cons of regulation. Actually, I think I can confidently say in this area that actually regulation does bring growth because it brings that certainty that you've mentioned. We've already seen, some of the benefits of that in the growth of the number of trust service providers through which were endorsed by EIDAS 1, and now we're on EIDAS 2. We've also got the 2020 regulation on freight transport information, which again enjoins the member states to create standards and to approve technology providers. The issue, though, is that a lot of this is really focused on e-citizenship. Now, if we look at EIDAS 2, for example, and maybe we'll talk about this later, about what the value of a digital signature is. But at the moment, the focus is very much on e-citizenship, on making sure that there is sort of a one-stop shop for all the services that an EU citizen will need, and that provided through service providers that are accepted across the European Union. But the problem is when we move away from private individuals to companies, and especially to digital documentation, and this was the issue that we had and with yourself, Nick, lobbied on in relation to the EIDAS review. The problem is that companies use documents. Okay, they're signed through individuals, but they use documents which are not, which are the sort of documents that we've been talking about: the negotiable instruments, the bills of lading, the warehouse receipts, the promissory notes, and the bills of exchange, and they have to be in paper. And that is the problem that a lot of the legislation around the world is that André alluded to, is trying to solve. So the Melita model law on electronic transferable records is a model law. It's basically a set of sort of recommended drafting for any country to use. It's been adopted pretty much in its entirety by Singapore. And after some work that we did with Abu Dhabi Global Markets, has been adopted by them. The UK at the moment is passing its and it's going through Parliament at the moment. I was speaking at a House of Lords Select Committee evidence session a couple of weeks ago. We have got in the UK our own version of Melita, which is dealing with the same issue, but in a slightly different way. But we'll get essentially to the same endpoint, which is that these documents, these paper documents, need to be valid when they're in digital form. As André has said, the technology is there. It's not difficult to use, but it is very transformative. The first time I ever got involved with this area was about 5 years ago with one of the UK clearing banks, which had a mid-cap customer that used promissory notes for working capital. They were very interested in the possibility of digitizing these, but we fell at the first hurdle, which was that under English law and under the law of all European countries, they are not valid when they are digitized, when they're transformed into digital instruments. So this is what these laws are trying to change. Now, that is something that we tried to bring to the attention of the EU. We were hoping that the EIDAS review would be the right place for it. But as I said, the focus has really been on trust services and e-citizenship for private individuals. The result of that has been that a number of countries like France and Germany have essentially gone their own way, and they are looking and are quite advanced in looking at reform of their legal codes, commercial code and civil code, to accept these, to make these sorts of documents valid. But the issue there, of course, is that we're going to have fragmentation across the union. It would be so much better if we could do this at a Brussels level. And so far, despite some support from countries like Estonia, where André and I will be very shortly talking about a number of these issues, especially around e-identity, we didn't get that support. And the belief seems to be, well, you can leave it to the market, you can leave it to industry. Yes, you can, but it will take longer, and it will result in fragmentation. It will result in differing timetables for these sorts of instruments across the union. So what might be valid in France will not become valid when it crosses the border into Luxembourg, and so on. So it's really important that we have uniformity across the union. We can only achieve that through through Brussels level legislation. So I plead, I beg to those of you who are watching this, who have that influence, please do think about digital trade documents and the specific requirements that it has.
Thank you very much, and I think it's worth mentioning that the EIDAS proposal, the original e-signature proposal, already has a hook in it encouraging member states to at least recognize digital documentation, though not making it binding. Maybe based on your experience in the UK and in Singapore and with Abu Dhabi, how radical a change in legislation is required? Is it a complex document? Would it mean amending loads of different pieces of legislation to get there? How is the UK going about this at the moment, and how extreme or cumbersome is the exercise?
So it's, well, to answer the last question first, how cumbersome it is will depend on the legislative process in each country. It's taken us, I think, 3 years in the UK working with the Law Commission. The point I would make, though, is that the French are kicking this off through a report from a marketplace association in which ITFA is involved. They'll produce a report. It will be looked at by the various ministries, and it will then they'll need to consider how they're going to translate that into legislative action. We don't think that there will be a change in the law until 2025. Now, you multiply, and this is a country that is fairly advanced in looking at these issues. You multiply that across the union, and you've got, the 26 countries will all need to go through that process. So you're multiplying the amount of work that you need to do. How simple is the legislation? Well, as you know, Nick, we suggested some really quite simple changes to EIDAS, which translated the essence of MLETR. As I said, unfortunately didn't get the required support, but it is actually a relatively simple thing to do. The UK legislation is about a page and a half, and it essentially says one thing: what you can do on paper, you can now do digitally in relation to these instruments, which the law previously required be in paper, and that's already you need to do. I think the suggested changes that we proposed were, no more than a couple of paragraphs. We need to look at another piece of legislation to do that. Now, the other approach is to do what Singapore has done, which is to adopt the whole of MLETR. It's not a very long piece of legislation. It's about, I think, 16 articles, takes 2 or 3 pages, but it's essentially saying the same thing: what you can do on paper. So that also deals with things like electronic signatures, which we don't need to deal with in the EU because we already have that. But essentially, it's saying one thing: it is what you can do. If it's a negotiable instrument, it's valid, equally valid in digital form as it is in paper form. And just an important point, this doesn't do away with the ability to use paper documents. We all know that they will be around for a long time, and they will be used side by side. And in fact, both the Melita and the English law both provide for conversion back and forth between paper, because we know that it will take a while for all sorts of people, companies, and actually governments to catch up with this, port authorities, tax authorities, and so on. So a lot of flexibility built into it, but we do need to have that at the very highest level if we're to get that standardization and uniformity across the union.
Interesting you mentioned tax, because this time last year we had Gerasimo Tomar, the Director General of DG TaxSud, talking to us about the digital transformation, and he really highlighted it was all about tax authorities' capacity to accept digital documentation. It was less about redesigning the tax code.
Correct.
I think maybe one last question, conscious of time, and given we've got a panel in a moment on the digital solutions around Know Your Customer and anti-money laundering requirements, what do you think this would do to the management, not just of trade flows, but also along a value chain? Because around the environmental and social standards, companies will be required to report much more through the value chain to know who are the originators and the various intermediaries in the trade flow. How do you think digital documentation could transform these sets of information along the value chain?
So I'll answer that and then maybe pass over to André quickly. But the other thing about digital documentation, it's created on a very secure system. Whether it's blockchain or something else, it's an immutable record of the information within that document, and it's signed. So you ally the information that you have in that document with whatever type of digital signature you have, that you need, say, a qualified electronic signature, the highest level, you are getting a very high level of identification attached to both the paper, where it's issued by, what's called sometimes in the jargon, a trust anchor. So people who themselves have been validated by governments or by others, chambers of commerce and the like. You trust these people as the issuers. You know that the document that's been issued has not been tampered with because it's very secure. And then you've got the signature added on top of that, which could be linked, of course, to that signatory, usually a physical signatory, that person's digital identity, maybe in a national registry. So you've got this fantastic sort of container of immutable knowledge in one digital document, which you cannot have with paper.
Thank you. André, any reactions?
Certainly also as SMEs are increasingly funded by new entrants like supply chain finance platforms, asset managers. When those new originators are entering the trade market to fund those SMEs, they want to offer a fully digital experience, which is why it's important for those very easy and well-established instruments like bill of exchange and promissory notes to be able to be traded fully digitally. And indeed, as Sean just mentioned, to include much more information than what we had on the paper version, because now we have a trail of information, as Sean just explained, and that piece of information is coming from factories on ESG requirements, and they will need sometimes to go not only to the funder, like the new entrants or the established banks, but also their partners in the distribution space, institutional investors, that are also new entrants into the trade space and are extending liquidity to originators, whether they are small originators like supply chain finance platforms or larger originators like SMBC and other top banks. And so that whole information has to be exchanged, but also kept private, but it has to be traceable because it has to be trusted, and it will be supporting regulatory obligations for all parties on the ESG requirement. So digitization is not just supporting indeed the move from paper to digital, but supporting the addition of new data that we didn't care of a few years ago, and to address regulatory requirements, certainly on the ESG track. And this is only the start of this whole process. But new entrants like the two categories I've mentioned, small originators funding SMEs and institutional investors in the distribution space, they need that data to be attracted by the trade asset class.
Thank you very much indeed to both you, Sean and André, for spending the time with us to talk us through this. I know we'll be working with you in thinking through the agenda for the incoming commission. I know it's a bit early yet from a commission's perspective, but we are starting to think through how we can help feed this into the next EU's agenda. And I think you've set out very nicely why this is so important. Thanks for kicking off our afternoon's discussion, and good luck in Estonia. Thank you very much indeed.
Thank you.
Pleasure speaking.